Hey. All righty. Well, welcome everybody to tonight's first-time homebuyer class. If you have any questions, please place them in the chat. I've got my trusted sidekick, Mike, with us tonight. He'll be answering any questions in the chat for us. But let's go ahead and get right after this. So let's start by defining what is a first-time homebuyer. A first-time homebuyer is somebody who has never had any prior home ownership, never owned a property. Or it's somebody who has not owned a primary residence in the last 3 years. So you may have owned a home way back when, but in the last 3 years, you have not owned a primary residence. That would make you eligible as a first-time home buyer. In addition, if you have owned a property but you have not lived in that home, so if you own an investment property but you don't live in it as your primary residence, you would still be considered a first-time home buyer. So the steps, the key steps to home ownership. How do you go about buying a home? Well, step number one is to go ahead and get pre-approved with our loan team. Mike is going to put the link in the chat. If anybody would like to set up a one-on-one appointment with our team, the link will be in the chat box. All you need to do is go there, click a time, a date and time, and you can reserve a one-on-one meeting with our team. We're going to talk about the different first-time homebuyer programs. What is the difference between a pre-qualification, a pre-approval, and a fast-track approval? Once we have your approval in hand, we can help you find a realtor. We have the best realtors in all areas we have access to. So if you do not have an agent that you are already committed with or that you are familiar with, we can help you identify a great agent in your market. You will then need to sign a buyer agency agreement. There was a major settlement recently by the National Association of Realtors. We'll get into that in just a little bit. Once you find a realtor, sign an agency agreement, you would then go out and start searching for your home. You get to go house hunting. That's many people enjoy the thrill of the hunt. Once you've identified the property you like, you get to offer, negotiate, and execute a contract. At that point, within the state of Illinois, so Mike and I are located in Illinois, there is a 5-day attorney review period. During those 5 days, if your attorney, for whatever reason, does not like any verbiage in the contract, or for any reason you change your mind, within the first 5 days, your attorney has the ability to terminate that contract, no questions asked. Once you pass that period, then you would be doing a home inspection and do a review of the condo documentation. If you are buying a condo, you want to make sure that association is healthy. There's no lawsuits. There's no pending litigation against that association. That is one of the things to be aware of when you're buying a condo. At that point, we would be issuing you a loan commitment, which is our promise to lend. Once you have a loan commitment, then you are able to do a final walkthrough where you are basically going through that property to make sure the property is in the same condition as when you wrote the contract, that they haven't changed anything, that there's been no damage to the property. So before closing, you're going to do a final walkthrough to make sure that the property is in the same condition as when the contract was written. You go to the title company, you sign all the documents, then you move in, and what Mike and I love the most are the housewarming parties. We get to celebrate your new status as a homeowner, which is fantastic. Congratulations to you. So mistake number one, the biggest mistake that home buyers make, is continuing to rent because it costs less upfront than buying. So the cost of continuing to rent versus buying can be up to $248,700 can be the difference between owning and renting. Where do we come up with that? Well, homeownership enables you to build wealth. There was a recent study done by the the Federal Reserve's Survey of Consumer Finances, that they determined that the median net worth of a homeowner, somebody who owned their property, was $396,000, whereas the median net worth of a renter was about $10,400. Big major difference between a homeowner and a renter. And what they have determined is that homeowners have a greater net worth, which is 40 times greater than renters. Homeowners get to build equity every month that they're making their payments. Part of their payment is going to pay down their debt, which is increasing their equity. The property, typically here in the Midwest, in the Chicago market, real estate goes up by about 4.3% annually. So every year, traditionally, the house is going up in value while what you owe on the house is going down, and that's creating greater equity. Then as a homeowner, you are able to have tax write-offs that renters cannot. When you're renting, you don't get to write anything off. When you're a homeowner, property owner, you get to write off some of those expenses. And then the primary residence equity is the single largest factor of a homeowner's net worth is the equity in your home. So, again, if you're renting, you're not even in the game, and all you're doing is watching the ship sail further and further and further away. So here we see a study that was done back in 2010, where you had a homeowner's net worth was approximately $203,000. Hope we got some folks in the waiting room. A homeowner's net worth was approximately $203,000, but a renter was approximately $6,010. If we fast forward that to 2019, we see that the homeowner's net worth went up to $254,900. So it went up by about $50,000, where a renter's went up to $6,270. So the renter's net worth barely went up by about $260, where the homeowner's net worth went up by $50,000. A huge dramatic difference between a renter and a homeowner. And like I said, if you're renting, you're not even in the game. You are, again, you're being left further and further and further behind. So the path to building wealth is owning real estate. So real estate gives you asset diversification. So you may have some money in savings in your 401k and your IRA. You may be investing in, stocks and bonds, but owning real estate is a way of diversifying that risk. It offers you the hedge against inflation, that when you own real estate, as inflation is occurring naturally, again, that happens whether you own real estate or not. There is inflation. A good inflation number is about 2.5%, 3%. So if inflation is about 3% and real estate is going up by about 4.3%, well, then you're at least keeping up with inflation. You're not losing money standing still. Owning real estate gives you a stable housing cost. What Mike and I do is traditionally going to offer you a 30-year fixed mortgage, or a fixed mortgage, we should say, whether it's 15, 20, 25, or 30 years. Predominantly, we're going to use a fixed interest rate. There are adjustable programs, but we don't really see them that frequently. Most clients choose to take a fixed rate where they know their payment will remain stable for the time period of their loan. Owning real estate also creates generational wealth. When you own your home, you have an asset that you can leave to your loved ones. When the day you pass, you can leave your real estate to your heirs, and that's something that's a true asset that they can hold on to. And then real estate finally creates a forced saving mechanism that as you're making your payment every month, you're reducing what you owe, you're paying down the principal little by little. The value of the property is going up through normal appreciation. And every time you make your payment, a portion of that payment is going to reduce the principal. Long story short, it's a forced savings mechanism. Mistake number two that home buyers make is not knowing all of your financing options. And by the way, guys, you don't need to worry about taking notes. We will be happy to send you a recording of this webinar. All you need to do in the chat is just type the word recording, and we'll make sure to get that out to you. Mike, if you could make a note of that. Mistake number two, not knowing all of your financing options. So where do loans come from? So they come from agencies known as Freddie Mac or Fannie Mae. Those are pseudo-government agencies. They come from the Federal Housing Administration, FHA, which is definitely a government agency. The Department of Veterans Affairs, so VA loans, fantastic source for mortgages for military veterans, for those who have served. We thank you for your service, and you're able to purchase a home with no money down. It's 100% financing for VA. And then there's also the USDA, the U.S. Department of Agriculture, also has a mortgage program in the more rural areas. You can actually purchase a home with no money down, 100% financing through the Department of Agriculture. Now, understand that not all lenders are created equal. Mortgage bankers provide access to most all of the programs that we're talking about. Large banks may not offer all of the loan programs, such as FHA, VA, USDA, DPA, which is down payment assistance, or non-QM, which is basically a non-traditional mortgage. Understand that banks and credit unions, their core business is to grow deposits, mark it up, and lend it at a premium. For the banks to have a bank on every corner, they have brick and mortar expenses. All of those facilities cost money. They're very expensive to maintain. Large banks will typically have stricter guidelines as they want to stay within their lending box. They're not very flexible. They're very conservative by nature. In large banks, understand you're just one of thousands of clients. To them, you're just a number, and that number really is how much do you have in deposit. That the biggest value you have to them is how much money you have in their savings and checking, because they are going to use that to lend to other people. Now, let's talk about the different types of mortgages that are out there. Number one are conventional mortgages. A conventional mortgage is anything that adheres to Freddie Mac and Fannie Mae guidelines. Fannie and Freddie also offer a renovation loan where you're able to get money to buy it and fix it all in one loan. So if you love the property, you love the neighborhood, but it's somewhat dated, the kitchens, the bathrooms, the roof, the windows, we can get you money not only to buy it, but also to fix it through a renovation loan. There's FHA, the Federal Housing Administration. The government also has a program where you can get money to buy the property, as well as through their renovation is to buy it and fix it. And we'll get into some details as to the difference between the programs. But so there's FHA and FHA renovation. And then there's VA, again, for veterans, military veterans can get a VA loan to buy the property, 100% financing, no money down. And I have to update this slide. VA also offers a renovation loan that, again, you can get money to buy it and fix it, no money down through your VA benefits. You've actually earned that loan through the service to this country, so we thank you for that. And again, your down payment was earned through your service. USDA, U.S. Department of Agriculture offers 100% financing on properties in rural areas. We would have to look up to see if a property is eligible for that. But again, you can buy with 100% financing. The non-traditional non-QM offers what we call a DSCR, debt service coverage ratio. That's for your investors. If the rent exceeds the payment, the property qualifies. For the self-employed borrowers, if you own your business, we can do self-employed loans where we do not need to ask you for your tax returns. We would qualify you based on an average of your deposits. So those are our bank statement loans. And then for independent contractors, we have loans that are designated. If you have a 1099, we would average your 1099 to determine your qualifying income. So there's a lot of different flexibility for investors, for self-employed, for independent contractors that we do have access to. So understanding your down payment and how much you need. So the conventional loans offer a 3% down conventional if it's within a community lending program. And the community lending is going to have some limitations based on income and purchase price. But if it falls within that, you can buy with as little as 3% down. The traditional Fannie, Freddie, or conventional loan is going to be 5% down. No, you do not need 20%. Way back when, there was a time that in order to buy a home, you needed to have 20% down. That is no longer the case. Now you can buy with as little or as 3 or 5% down conventional, and some of the other programs that I've mentioned, like VA and USDA, which is 100%. The conventional renovation loans follow the same guidelines. It's either 3 or 5%, depending on whether it's in a community lending program or not. FHA, great program. You can buy with as little as 3.5% down on both the traditional and on the renovation loan. You can get money to buy it and fix it with as little as 3.5% down. The VA is 0 down VA for both traditional and renovation. No money down to use your VA benefits. USDA, again, Department of Agriculture, is no money down. The non-QM, so your bank statement and 1099 for self-employed and independent contractors, for owner-occupied properties, it would be only 10% down. And if you are an investor using our debt service coverage ratio, then you would need 20% as an investor. So let's talk about two terms. One is mortgage insurance and the other is homeowners insurance. So what allows the industry to lend you money with less than 20% down is the invention of mortgage insurance. Mortgage insurance came out, and what it does, it actually protects the lender. If for some reason you buy a house, you're not able to make the payments, then the mortgage insurance company would basically cover the loss that the lender would have by having lent to you. So traditionally, if a bank has to foreclose, it's going to cost them about 20 to 30% to recover a property. And that's what the mortgage insurance protects them of, that if they have to foreclose, the insurance company will basically take the loss instead of the lender. So when you buy with less than 20% down, a portion of your payment is going to pay for the mortgage insurance, and then it's just built right into the payment. The other part is the homeowner's insurance. So when you decide to buy a home, you say, I want to buy a house, and I'm going to go borrow a few $100,000 from the bank so that I can go buy this house. It's a $300,000 house. I want to buy that, and I want to put 3.5% down FHA, which would be $10,500. And you're saying, listen, if I don't make the payments, you can take my house as collateral. But what's important is that property has to be insured. The property insurance protects the property and it covers any damage like fire, theft, natural disasters. It provides liability in case somebody were to fall and get hurt. So the property insurance protects the property. The mortgage insurance protects the loan. Both of those are, protecting the lender because they want to make sure they're going to get paid back. If you don't pay, they take the house, but they want to make sure that the house is in decent condition, that there's been no damage to it. So that's the difference between mortgage insurance and homeowners insurance. And if you have any questions, please put the questions in the chat. I'm going to keep everybody muted, but if you have any questions, like I said, please put them in the chat and we will try to get those answered before we are done. So here's an example of how much you would need to buy a home. You want to buy a $300,000 house. Minimum down payment with FHA is 3.5% down. Traditional closing costs are going to be about 3%, or in this example, it would be about $9,000. So your down payment and closing is $19,500. And then FHA allows the seller to pay up to 6% for the buyer's closing costs. So in this particular case, we would look to negotiate the $9,000 in closing costs. We would negotiate that for the seller to pay. You could get a gift from mom or dad, from a family member, mom, dad, brother, sister can give you a gift, and therefore a $5,000 gift, and then all you would need to bring to closing or to buy that home would be as little as $5,500. So FHA requires that you invest 3.5%, but that down payment can be in the form of a gift from a family member, and then we can look to negotiate that the sellers pay your closing costs so that you're able to purchase this home with as little money out of pocket as possible. So let's talk about the FHA loan, Federal Housing Administration. What they do, they actually insure the loan. So the government doesn't actually lend you money. We, as the lender, we lend you the money, while FHA, or the government, guarantees or insures that loan. In the event that you can't make the payments or you don't make the payments, that's when the lender would file a claim against FHA. FHA would pay the lender off, and then FHA would be, would be the one to handle the collection of those funds. So FHA really insures the loan, but they don't actually lend you the money. Conventional, again, we mentioned conventional loans earlier, where conventional loans are written by Fannie Mae and Freddie Mac. So as long as we write the loan following Fannie and Freddie guidelines, they will basically secure that loan. And it is a pseudo government agency, but as long as we write with their guidelines in mind, they will basically service that loan from us, as long as it met those guidelines. So the benefits of an FHA loan. So FHA offers low down payment options with as little as 3.5% down, 3.5% with a 580 credit score. And then you can purchase with as low as a 500 credit score. However, you would need 10% down. FHA offers an easy refinancing option that with FHA, they offer a streamlined refinance, which basically says that if you are making your payments on time, we are able to qualify for that refinance without having to use your tax returns and pay stubs again. You already qualify because you're making your payments. So as long as you have a benefit by refinancing, that we're lowering your payment or we're lowering the years on your loan, lowering the term, you have a net benefit, and you would be able to do that loan with a streamlined refinance. So again, you don't have to qualify. You qualify once, which is when you buy the house. They offer low mortgage rates. Typically, the interest rate on an FHA loan is slightly lower than a conventional loan, so that's an attractive option. And they offer higher debt to income ratios. DTI is debt to income. What percentage of your monthly income is going towards your housing, and what percentage is going towards your total debt, your house, cars, credit cards, personal loans, student loans, anything like that. Those are your DTIs. FHA allows for higher DTI ratios. You can choose between a 15 to a 30-year fixed interest rate. So it can be 15, 20, 25, or 30, or you can take an adjustable rate. Again, we have them available. We're not really using them much. Most clients in today's environment prefer to take a fixed rate where they know that payment won't change for the term of the loan. Down payment assistance programs are available. Both the down payment assistance and grant programs are accepted with FHA. And with FHA, the seller can pay up to 6% of the buyer's closing costs. Conventional loans only offer 3% with minimum down. So FHA is a little bit more lenient or liberal when it comes to seller paid closing costs. So let's talk about some down payment assistance programs. Typically, they're going to have a slightly higher interest rate. Understand that nothing's for free. The money they're giving you is typically going to come in the form of a slightly higher interest rate. They may have higher points. So points is just a fancy word. 1 point is a fancy word for saying 1% of the loan amount. So if you borrow $100,000, 1 point would be $1,000. That's just the definition of a point. So the DPA programs may have some higher points. They will have a more restrictive credit score. So FHA allows for as little as a 580 credit score. The down payment assistance programs require a 640. So slightly higher credit score. Their debt to income requirements are a little bit more restrictive. Just something to be aware of. And then they typically will have income limits. They want to make sure that the right people are the ones getting this assistance. So, if you're making $1 million a year, you probably don't need help for the down payment assistance. So they just want to make sure that the people that are getting the down payment assistance are, moderate, lower to moderate income families. You may have to pay back some in full or through monthly payments. Again, a real popular one is where you can get $10,000 in down payment assistance, and then it would just be a monthly payment every month as part of your mortgage payment. They will have purchase price limits, so there is a limitation as to how much you can buy and get down payment assistance. And then they also have what they call negative equity. When you first buy the home and you get down payment assistance, understand that day one you're actually going to owe more on the house than what you paid. So you may have bought that house for $300,000. You get a $10,000 DPA, and you might owe 308, 309 on that house that you bought for 300. So you actually owe more on the house than what it's worth or what it paid. However, keep in mind, day one you owe 308, 309, but that $300,000 house, if it's actually going up in value by 4% a year, as we talked, that in 1 year that house is going to be worth somewhere around $312,000. So you've already earned back that money in the form of equity because the house went up in value. Grants offer financial assistance from local governments for home buyers. So they come from different government agencies. They're often targeted to first-time home buyers or specific communities. They can help cover down payment, closing costs, or home repairs. The eligibility may depend on income, location, or other factors, and grants typically do not need to be repaid. However, They may have a minimum time period in which you need to live in the home, which may be 3 years, 5 years, 8 years, or 10 years. Each grant program is slightly different. But again, these programs exist to help you transition from a renter to a homeowner. And again, we said in the beginning that your benefit from being a homeowner versus a renter is dramatic, a $250,000 difference just by becoming a homeowner in your net worth. So let's compare FHA to conventional. FHA is a minimum 3.5% down. Conventional could be 3 or 5%, depending on whether it's a My Community loan. Minimum credit score is 580 for FHA, where conventional is a 620. The maximum debt to income ratio, the DTI that we talked about with FHA, can be 56.99, almost 57% of your gross monthly income can be allowed to go for your house, cards, credit cards, cars, credit cards, everything. Where conventional is going to limit you to a 50% total debt to income ratio. Loan limits for FHA on a condo, townhouse, single family home is up to $524,225. So almost $525,000 for a single unit, $671 for a 2-unit, $811 for a 3-unit, and slightly over $1 million for a 4-unit building. So understand, if you bought a 4-unit building or you borrowed $1 million, putting 3.5% down, that's only $35,000 down. And if that property is going up by 4% annually, after a year, that house has gone up, or that property has gone up by $40,000, which has earned back your down payment. Huge leverage. And that's the power of real estate, that with relatively little money up front, you can control a lot of assets which are going up in value. Conventional, single family condo, townhouse up to $806,000, 2-unit $1,032,000, 3-unit 1.248, and a 4-unit building up to $1.551 million, $1.5 million that you can purchase with only 5% down on a 4-unit building. Just massive leverage. So just keep that in mind. Minimum required investment for FHA is 3.5. For conventional, it's 3 or 5%, depending on the My Community status. So what can you use for down payments? 401k or retirement accounts, yes. Selling personal properties, goats, livestock, motorcycles, jewelry, yes, as long as we can document that you owned it and that you sold it, we can use that for down payment. A gift from immediate family, yes. Savings in the bank, stocks, bonds, of course. Credit cards, no. Loans. You can use a loan for down payment as long as it's secured by collateral. So, for instance, if you own a car that's free and clear and you go to the bank and borrow money against that car, you're using the car as collateral, and that would be allowable funds for a down payment of a house. Cash in your drawer, cash at home is not allowed. Your friend's account who's not on the loan with you, not allowed. Some quick answers as to what you can and can't use. To introduce the team itself, the Loya team, we are mortgage bankers. Mike and I started in this business in 1995, so we're pushing 30 years in this business. We've seen. Again, I'd like to say we've seen it all, and if we haven't seen it all, we've seen a lot. We've financed over 10,000 homes. We've done over 500 renovation loans. And beyond just us on this is the sales team up front. Beyond just the sales team, we have the internal team, which includes the disclosures, the processors, the underwriters, the lock desk, quality control, closing, funding, post-closing. There's a lot of people that are involved in getting you to closing, getting you into your dream home. Mike and I have the honor of leading the team, but there's a whole bunch of us in the background making this all happen. So if you have any questions, please put them in the chat box. Again, let's start by scheduling your one-on-one appointment with the team. all you need to do is click on the link that that Mike has put in there. Mike, can you put the link down at the bottom again to start with? And that's the one that ends with book. All right. So any questions, put them in the chat, and let me just take a little sip of water and we'll keep going. Mike, any questions so far?
No questions as of yet.
Okay, awesome. All right. Mistake number 3 is not getting pre-approved. So setting up a loan consultation, we're going to do 3 things. We're going to take a look at your credit. We're going to take a look at your income. Last 2 years worth of tax returns and pay stubs. That's what we use for qualifying. And we're going to take a look at your assets. Where is the money coming from? We're going to look at the numbers, determine what it is you're able to qualify for. And we're going to increase your bargaining power by choosing the correct approval. Estimate your total monthly payments and total investment, and then help you identify which loan products help fulfill your needs. Every situation is a little bit different. So, again, Mike and I, we're here to show you the options, but ultimately you're the one that's going to decide which is the right program for you and your family. Different types of loan approvals. A pre-qualification is good, a pre-approval is better, and the fast-track pre-approval is the best. So let's take a look at those. Pre-qualification is basically, it's all verbal. You're going to tell us, all of your information is verbal. We can or don't have to run your credit. You can just tell us what your credit score is. Automated underwriting is not necessarily run. You provide everything verbally with your income, your down payment. It's the lowest form of qualification. Most sellers and their agents will not accept this type of qualification for an offer or for showings because nothing has been validated. It's a good guess. When you tell us how much you make and we give you a guess as to what you qualify for, that's about all it is. A pre-approval, slightly different. We are going to enter your information into an automated underwriting system, a computer system. We are going to review your income, your pay stubs, your tax returns. Your credit is going to be reviewed by us, and your down payment. Where is the money coming from? We're going to look at your bank statements, identifying any large deposits and making sure that everything is fine. Many buyers use this type of automated underwriting approval to view properties and submit offers. So traditionally, that's a good step. Finally, the FastTrack Approval. FastTrack Approval is we're going to take all that information that we gathered during the pre-approval and we're going to submit it to the underwriting department. We're going to have the underwriters look at all that information and issue a mortgage commitment. That's the actual promise to lend you money, and it'll be with the only conditions of getting an appraisal and title. The underwriters will review the income, the credit, the assets, and they will give you an actual promise to lend. It'll be a faster close with only final conditions, title, and appraisals that are needed. It is the strongest type of approval. This approval will give the seller confidence to accept your offer, and you'll be able to close faster and negotiate better terms because now the seller knows that you've done all of the homework up front and you are in essence a cash buyer because you've done all of that work already. So what are the underwriters looking for? Capacity, basically. Do you have the ability to repay this loan? They're looking at your debt to income. What percentage of your income is going towards your housing, is going toward your total payments. How stable is your employment? How stable is your income? That's capacity. Capital, where is the money coming from? Has it been saved over time, or is it all coming from a gift from mom or dad? Or you're going to sell assets, or you're borrowing against your car. Where is the money coming from? Character is, bottom line is it's your credit history. Do you have bankruptcies? What's your credit look like? Your job stability, your education, your experience. That's what goes into character. And finally, collateral. So we're asking the bank to lend us a few $100,000, and in exchange, we're using the house or the property as collateral. So what is the value of the property that you're using as collateral? What is the condition of the property? What type is it? A single family home, condo, multi-unit? Each different category is considered different risk. Title search. We want to make sure that the only loan going against this house is the one we are giving you at the time of closing. All of the seller's loans, all of the seller's liens have to be paid off by the title company, because certainly you don't want to borrow a few $100,000 against a house that owes a different bank money. We want to make sure that though all of those loans are satisfied by the time of closing. Again, as they say, real estate, location, location, location. The house sitting on top of the highway is a worse location than one on a residential tree-lined street. Where do you want your children growing up? And all of these factors is what the underwriter determines whether the collateral is sufficient to secure the loan and protect the lender's investment. The lenders want to make sure that they are going to be able to get paid back. So what to do when you're shopping for a home? Number one is schedule a loan consultation. Call us if you have any questions. Continue living at your current residence. Continue paying your mortgage and rent. Keep using your credit as normal. Keep your same job. Keep your same insurance. Stay current on all existing accounts. Know that we are going to continue to ask you for additional documentation, your current pay stubs, your current bank statements. What not to do. Don't make any large purchases. Don't change banks accounts. Don't move money around. Don't transfer balances. Close any credit accounts. Consolidate your debt. Don't do any moves with your credit without talking to us. Any of those things could affect your credit score. Don't change or quit your job without talking to us. Don't max out or overcharge your credit cards or pay collections without talking to us. Sometimes paying a collection off can actually hurt your credit rather than help it. So don't move your credit around without talking to us once we have gotten you pre-approved. Very important that you guys pay attention to that part. Mistake number 4 is not working with a buyer's agent. So a buyer's agent is, why you should use a buyer's agent when purchasing your home. They are going to offer you expert guidance and market knowledge. They have access to listings, including off-market properties, what the realtors refer to as the private listing network. So not all properties get released to the public. Realtors hold some of those back. Some of the best deals available are in the private listing network. The only way you can get them is through a realtor. They offer you negotiation skills. A typical home buyer, might buy 3, 4, 5 homes in their lifetime. Top performing agents do 3, 4, 5 deals in a month. So their level of experience is much higher than a typical home buyer. They offer you objective advice. They help you in handling the paperwork and legalities. They connect you to top professionals. They save you time and stress. And they can help advise you in complex situations, as well as help you determine future resale considerations. Which property could go up in value more than the other? What neighborhoods go up or down more than the others? This is like anything else, it's an investment. Which one, a great realtor can help you determine future value opportunities. Buyer's agent ensures that you have a knowledgeable ally on your side and working to protect your interests and guide you through the complexities of purchasing a home. So recently, there was a National Association of Realtors settlement. So it was a big lawsuit. And what happened was, not too long ago, all the commissions were negotiated and paid by the seller. The listing agent or the seller's agent would determine how much the commission to sell the house was. They would negotiate it with the seller and determine what it would cost for the seller to pay that house. And then the listing agent, the seller's agent, would offer a cooperating commission. So they would offer compensation to the buyer's realtors and say, we'll pay you X% if you sell this house. And there was a big lawsuit that said, hey, this isn't fair. Why should the sellers or the listing agent determine how much the buyer's agents are getting paid? And ultimately, that the sellers were being forced to overpay because they never got a chance to negotiate the buyers, what they were paying to the buyers agents' commissions. So big lawsuit came out, and the settlement basically said that you now, as a buyer working with the realtor, you have to execute an agency agreement. You have to sign a contract with your realtor, just so that everybody knows what the commissions are and who's paying. What is the compensation and who is paying them. Within the settlement, it's you need to or within the buyer agency agreement, you need to determine how much your agent is going to get paid and who will pay them. So again, in that conversation, it's you might talk to your agent and say, hey, listen, I've got plenty of money. I can cover my down payment, my closing costs, and my buyer agency commissions. I'll pay it all, no problem. Or that conversation might be like, look, I can come up with my down payment, but I need help covering the closing costs, and I also need help covering my realtor's commission. So all of that needs to be negotiated as part of the purchase and sale agreement. So as long as you understand who's paying and where it's being included, that's what is important here. So what we as the lender need to know is, again, commissions are negotiable. It's between you and your realtor, but understand that we need to understand what the agreement is, because if you have agreed to pay your agent a certain amount of money, we need to show that you have that money in the bank to cover those additional expenses. So understand that the buyer agency agreement spells out, how long your agreement is. It could be for 24 hours. It could be for a weekend. It could be for 30 days, or it could be for whatever period you agree to. And then you and your agent need to agree as to how much they're going to be paid and who's going to pay them. Are you going to pay them directly? Or are you going to negotiate that the seller cover the seller cover the realtor's commission, your realtor's commission, as part of the purchase and sale agreement? It's a little wordy, I know, but just understand realtor commissions are all negotiable. You need to have a real conversation with your agent. How much are they going to get paid and who is paying them? And Mike and I just need to know what those terms are. So we need to account for those funds, if we need to account for those funds for closing. So if you're paying for them, we need to show where it's coming from. If the seller's paying for them, we don't need to account for that because it's not money that you need to come up with. Okay. So if you have any questions, please put them in the chat. Again, encourage all of you to set an appointment on our calendar. It's Michael put that link down at the bottom again. And again, as we're going through this, guys, if you are getting a lot of value for your time here, if you know of anybody else who may be thinking about buying a home, we would like to ask you guys to invite them to our next webinar. We do this webinar every week, one week in English, 1 week in Spanish. So if you need anybody, if you know anybody that would like to attend, Mike will put those links in the chat as well. So, and then Mike, if you put for Spanish, if you put in there seminario.loyamortgageteam.com is the Spanish webinar. Okay. Seminario, SEMINARO, something like that, right? Seminario. So moving forward, skipping a home inspection. So I know, again, buying a home is expensive. There's a lot of fees flying everywhere. And you say, hey, I'm going to skip a home inspection, but skipping a $450 home inspection could cost you up to, $20,000. When you purchase a house, you're unaware of certain things like structural issues, electrical, plumbing, or other health and safety issues. You risk inheriting a non-structural safety issues such as mold, radon, or carbon monoxide. And you also miss out on knowing what the future repair costs of those items are, and you lose negotiating power. When you get a home inspection, you can take that back to your attorney, and you can actually look to renegotiate the price if there's a lot of problems with that house. And if you do a home inspection, you love the house, but the inspector gives you a list of everything that needs to be repaired, you can take that list and now you have an idea of what needs to be included into a renovation loan. As we mentioned, you can get money to buy it and fix it. It might be an issue of, hey, let's renegotiate the price because we know that we're going to have to spend money to fix all of these things up. We still like the house. We're still willing to do it, but we need to buy it at a better price. So when you have a professional home inspection, you can go back to the seller to negotiate those items, right? So again, if anybody has any questions, please put those in the chat. Again, we encourage you to set your one-on-one appointment, webinar.loyalmortgageteam.com/book. That'll take you to our calendar. Pick a day and time. There's no cost. There's no obligation to that. Let's recap what we discussed today. Number one is knowing all of your financing options. Getting pre-approved before home showings is very important. Don't just go to your bank to get a mortgage. Explore your options. Not having an agent represent you to ensure that they have your best interests at heart is very important. Even when buying new construction, we've seen many buyers go buy new construction and understand that the sales rep at the sales center works for the builder. They do not have any responsibility to you. There's no fiduciary responsibility to you. It all belongs to the builder. So, again, you want to make sure that you are going in represented. Don't skip a home inspection. Again, even if you're doing new construction, a lot of things that we have seen over the years. The biggest mistake of all is continuing to rent over buying. If you are renting, you're not even in the game. The ship is leaving you further and further and further behind. You're on a deserted island just watching the ship sail away. So we want to see you guys get in the game. We want to see you at least be on the ship so that you are participating, right? So we hope that you found all of this information interesting and valuable. And again, get ready for your FastTrack approval. We encourage you to set up an appointment with our team. My team and I are personally invested in your success. If you take this step now, schedule your appointment. There's no cost, there's no obligation. We will even give you $500 towards your lender fee. So we will actually pay you to set an appointment with us. We want you pointed in the right direction. Schedule your call now. Earn yourself $500. And like I said, there's no cost, there's no obligation. The only thing that we do ask from you guys, if you know of anybody else who may be looking to buy their own property, whether it's their first home, their trade up, trade down, they're empty nesters or investors. If you know of anybody, if you would share the registration link to our webinar, we do this every week. 1 week in English, 1 week in Spanish, twice a month Spanish, twice a month English. We are here to really try to inform the community as much as possible and help them out. Again, we're offering these consultations limited time basis. Once the calendar is full, it's full. And then I see here that iPhone requested a recording of this. Happy to send it out to you. If you could send Michael Markham a private message in the group. If you could send Michael your email address, we will make sure that you get a recording of it. If anybody else wants a recording, just in the chat, write the word record or recording. We'll get that out to you. We also do on a monthly basis, we do a renovation webinar that we talk specifically about the programs, conventional FHA, VA, the programs which are designed to help you buy and fix a home. There, like I said, plenty of money available to update those properties. If you already own your home, we do offer a renovation refinance. Again, I encourage you all to set an appointment and we can have a one-on-one conversation. To the iPhone user, if you could send Mike that email with your send Mike a message with your email address and we'll make sure to get you a copy of the recording. If anybody else would like that, just put recording in the chat and we will get that sent out to you as soon as the recording is done. Mike, anything else to add?
No, nothing really to add other than, we're happy that you decided to come in and view the webinar. Hopefully everyone will book an appointment. We can actually give you a lot more information on your own personal scenario when we talk to you. Typically, I will be the one that you will talk to most of the time when it comes to the appointment. So, like I said, feel free to book an appointment, and I'll be happy to see how we can help you out.
Awesome. And then again, Mike, if you can make note of iPhone users' email so we can get that sent to her.
I got it.
Him or her. And thank you everybody for your time this evening. Again, it's an honor and a privilege to help you guys with your dream of homeownership. We are, honored and grateful to be of assistance. Again, is just pick a date, pick a time, and you can reserve that time slot. So with that in mind, thank you everybody, and have a wonderful evening.